the financial centers of the world. This is Bloomberg Markets with Alix Steel and Guy Johnson.
Monday the 9th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel is back. She missed payroll Friday, but at least she's back for the commodity sell-off on a Monday.
I want to come in for what's really near and dear to my heart. You're absolutely right. I did miss jobs day, but the number was truly tremendous. We'll talk about that throughout the 2 hours and what that means then for yields as well. But I'm looking at commodities today, Guy. They're crunchy commodities. So you're taking a look at gold futures off by over 1%. That's after basically a flash crash overnight. Oil also getting hit very hard, down about 10% in the last 7 days. We'll break that down as well. So part of it is a broadly stronger dollar, but now we're seeing the Bloomberg Dollar Index flat. You have to wonder if that jobs pop has now kind of overstayed its welcome. And the 10-year yield up 1 basis point, broken out of that range above that 120 on that good jobs number. But then how do we go from here? Are we really live when it comes to Jackson Hole? Are we really pushing forward our Fed rate hike expectations? Still a question. We'll talk about that. And all of that to say, S&P is down 0.2%. You got yields up down 1 basis point. You got a little bit of money going into tech. But broadly speaking, it's a little bit heavier market as those crunchy commodities, Guy, take the story.
Just as a bit of context for everybody, I used the phrase crunchy the other day. Alix thinks it's hilarious.
You said crunchy bits. It was crunchy bits.
Yeah.
Not the crunchy bits.
And now she thinks it's hilarious. So it's now going to incorporate it into everything. The data, the employment data are really worth paying attention to at the moment. We're getting JOLTS numbers. These are job openings. This is really important data because it's indicative of the kind of forward-looking elements of the labour market. The labour market generally rear-view mirror. JOLTS is forward-looking. Last month, the May data was a record. This data that we've just got dropping onto the Bloomberg right now is even stronger, 10 million. The market was looking for 9.2, Alix. This is an unbelievably strong number, and it really emphasizes the skills gap, the mismatch we've got in the United States, and the fact that the demand story is there, but the supply side of the U.S. economy still is not responding. This is a hugely important number, and the previous number's been revised higher as well, up to 9.4. Just highlights there are huge numbers of jobs out there at the moment, getting strong payroll data on Friday. And this points to even stronger data going forward, Alix. And
it raises the question, where does the power shift? There's a really interesting article that talked about the dynamic of the two. So either this means that workers are going to get more power because they're going to demand more wages, or workers are going to demand other stuff, like I want to work from home 4 days a week, which means you're not going to get that kind of wage and inflationary pressures.
But in theory, logically, this should dictate the fact that we are going to see second-round effects. We are going to see potentially wage price inflation becoming part of the narrative. We'll talk to Bill Dudley about this a little bit later on the program. Let's talk about what is happening down in D.C. The U.S. Senate moving closer to passing that $550 billion infrastructure package. This is kind of phase one, though. Lawmakers will be picking up the debate when their session begins. That's happening in a couple of hours' time. Let's talk about this and what comes after it. Bloomberg's Washington correspondent, Anne-Marie Jourdain, here with the latest.
Hi, Guy. As you say, phase one of many to come. So basically what it looks like is we're going to get the green light on the bipartisan infrastructure agreement, potentially a vote this evening or tomorrow. There's a few elusive amendments they're working through, one specifically on cryptocurrency, and then another potentially on how to reuse COVID funds with state and local authorities. Potentially, if it's not used, can be used towards the bipartisan infrastructure agreement. But it is looking like that is going to pass with also enough Republican votes to put it over the threshold. What comes next is we're going to have the budget resolution. This is the Democrat-only setup for the budget reconciliation. Basically, what it means is that the Democrats are going to use the budget as a way to have their spending plans, $3.5 trillion worth of health, child, climate, all these kind of initiatives. And then after that, they're going on recess. But what it does is it sets up a very difficult and going to be quite a spiky September, I would say, in Washington, D.C., and how they get both these bills passed through.
It'll be a crunchy thing. It'll be very crunchy. Anne-Marie, thanks a lot. Bloomberg's Anne-Marie Jourdain joining us there. All right, well, the U.S. top infectious disease Dr. Anthony Fauci says he's strongly in favor of speeding booster shots to people with weakened immune systems. Here's what he said over the weekend.
We need to look at them in a different light than the durability for a normal person, which means that we will almost certainly be boosting those people before we boost the general population that's been vaccinated. And we should be doing that reasonably soon.
For the latest, I want to bring in Bloomberg senior editor for healthcare, Drew Armstrong. Drew, this is also after Israel is starting now to vaccinate those that are most vulnerable for that booster.
Yeah, that's exactly right. I mean, we've known for a while that obviously the protection from these vaccines is very good, but not perfect. And for people who are, for one reason or another, slightly more vulnerable, either because of their age or health conditions, or may have some level of immune deficiency, combine that little bit of inherent, weakness against the virus with a lot of viral spread going on, and this being an ongoing and in some places quite dangerous pandemic in the United States. And you're seeing this move towards saying, okay, we need to figure out, given the context, both from a medical standpoint with how these vaccines work and what's going on out in the country right now, you're seeing this acknowledgement that these folks are likely going to need booster shots and need them relatively soon in order to be protected, both, from a biological standpoint and against the kind of current situation with the virus here.
It was interesting to see BioNTech upgrading its guidance in terms of what is expected, and third-round boosters certainly look like they're going to be part of that. Bloomberg's Drew Armstrong, thank you very much indeed. Let's turn our attention to a different subject. The fires that have been raging in Greece for nearly a week show no sign of abating. Meanwhile, in California, firefighters are still battling with the second largest fire in state history. The Dixie Fire has been now raging for 25 days. This as a major new report finds that some of the devastating impacts of global warming are now unavoidable and maybe irreversible. Let's bring in Kit Connalidge of Bloomberg Intelligence. Kit, let's talk about what is happening with these fires. Can you bring us the latest and just give us a sense of the impact that they are having?
Yes, good morning. I'm focused on the utility infrastructure, but it applies more generally, obviously, when you have these massive multiple square mile fires. They're going to affect a lot of residences. A lot of people have left their homes, been forced out. People get killed and injured. So obviously, disaster is not too strong a word. And clearly you're seeing that they occur when you have a bad combination of drought, heat, and high winds, and some combination thereof. And obviously that's where the report on the climate comes in, which is that we're seeing those kind of conditions a lot more these days and creating massive problems for people and for infrastructure such as electricity.
All right, Kit, thank you very much. We appreciate Kit Connalidge of Bloomberg Intelligence joining us there. And Guy, as Kit mentioned, this comes on the heels of that report that was received overnight that talked about how it's unequivocal that humans caused global warming and that we have to speed the rate of change down or else the disasters will really keep on mounting.
Absolutely, and this ahead of COP26, which is going to be later on this year in November up in Glasgow, and the struggle to get everybody on the same page. Basically, we have to stop emissions now if we're not going to hit some critical tipping points. And this is the first time, as you say, Alex, unequivocal, the connection between human activity and what we are now seeing in the climate. And from that perspective, it's no surprise then that a commodity like oil would be down. It's also related to the day-by-day tick of the virus counts rising, as well as for the risk-off feel and China shutting down more regions and airports, etc. But all of this is a part and parcel, I mentioned this earlier, of a broader commodity sell-off, Guy, that really got gold whipped up into a copper as well. Iron ore is getting really hammered, so all of the commodities really selling off on this Monday. Yeah. And Alex is back to talk about it. She can miss payroll Friday, but missing a Monday when we see this kind of price action? Totally. Can't do that. Well, I mean, but if I did miss it, Guy would have so much fun railing on me for a while on that. Just make that clear. Okay, this is true. Well, coming up, we're going to talk more about gold. It's trying to claw back after a flash crash. We saw prices drop over $60 in minutes. It was really amazing. We're going to speak to the CEO of one of the world's top gold producers, Mark Bristow. Barrick Gold joins us now. Also some breaking news for you concerning sunscreens. A research study now finds that cancer-linked chemicals can also affect hormones that are in some kind of sunscreen. They're petitioning the FDA to pull more of those sunscreens from the shelves.
However, no surprise, an industry group is saying that this kind of research perpetuates misinformation. J&J, one of the guys in the crosshairs, though, not really getting affected. That stock's still up by 0.3%. This is Bloomberg. Live from New York, I'm Alix Steel, along with Guy Johnson over in London. This is Bloomberg Markets. As Guy and I were just talking about gold pairing some of its losses after an early morning flash crash. Want to get more into that with Bloomberg Markets Live reporter Kriti Gupta. It was something you don't expect to see overnight on a Sunday for gold.
Oh, absolutely. And it was the perfect storm for gold. You really had the Asian traders processing that jobs report from last week. You had light liquidity. You even had technical levels triggering some of the stop loss. I know we say that for everything, but that's really what happened. $60 in just the span of a couple of minutes. But it wasn't just gold that's crashing this morning. You're seeing this become a commodities-wide story. All the commodities lower. A lot of this has to do with China. You start to see a lot of big banks, Goldman Sachs, JP Morgan, start to downgrade some of that big Chinese global growth. And that, of course, is going to have a read-through into the demand picture. Look at this. Commodities down across the board, really also feeding into some of those Delta variant concerns and, of course, other variants that are popping up as well. But the big question here is how does this spill through into the other asset classes, especially when you have the Fed saying, well, this inflation, this commodity-driven inflation is transitory. Don't worry about it. Yields telling us something different, though. Take a look at this. They tend to move in tandem, yields following commodities, until recently on the right side of the chart, you start to see that divergence. But hey, look at that correlation. On an intraday basis, moving in tandem, what does that tell you? A lot of the bond market is paying attention to the Fed, but also paying attention to inflation, kind of avoiding the Fed a little bit. So let's see how that plays out.
Great stuff, Kriti. Thank you very much indeed. Bloomberg's Kriti Gupta on what's happening in the commodity space. Let's stay in the commodity space. Barrick reporting its second quarter results a little earlier today. The world's biggest bullion producer beating estimates, higher metals prices, countering the impacts of rising costs and lower output. Joining us now, Mark Bristow, Barrick President and CEO. Mark, always a pleasure. Let's just talk about the price, if we might, for a moment. Every time I talk to you, you tell me that you are a long cycle business, that you're in this for the long game. But nevertheless, I'm curious to get your short-term take on what is happening. Everybody's now increasingly believing that the Fed is going to taper its QE program. That's likely to be dollar positive and potentially gold negative. What's your view of the setup?
So, Guy, I think, that little segment into the gold price at the start of this interview really brings home my point, and that is, we run mining businesses for the long term, or we should, and this short-termism is something that comes and goes. I think more importantly, your question around the Fed and what it's going to do on the back of the economy, the U.S. economy. I think we got to look further than that too, to the global economy, and whether we've actually seen the full impact of the irrationality of the way the world has managed COVID and the impact it's going to have on the global economies and ultimately the global economy. So still very short term in the U.S. sense, as it is in times like this. I'll take you back to 2008, 2009. We only saw the full impact of the global financial crisis in 2013.
Fair enough. Mark, but along those same lines, if you do see, say, higher gold prices because of inflation worries, that winds up pushing up the cost of everything else. And we've seen that. Oil, copper, all the input stuff that you have to deal with. On the call, you were talking about the fact that your efficiency gains were enough to offset these kind of cost increases. And I'm wondering how long you think, how much more can you wring out of those efficiency gains if we continue to see higher input costs?
So, Alex, there are two things that drive cost, and many of the commodities are the same because we measure our costs in cost per ounce, not in unit cost per ton. And so one of the pressures the gold industry is facing is the cost per ounce pressure, which is really a grade-driven thing. We've looked at the impact. There's certainly evidence of higher. The biggest driver for our costs right now is steel, and that's really impacts our big capital projects. We've bought a lot of our steel forward. People are talking about transitionary impacts. We've expanded our stock so that we can manage that. we're still consolidating the two companies. There's bigger buying power. We approach things slightly differently to many other companies, but the big focus for me is the quality of the assets, the grade that we mine at, because that keeps our costs under control.
When are we going to see significant production growth, do you think, Mark?
You're not going to, Gar. We're at a real squeeze because we don't, as an industry, and I would say that generally we just don't. We've sort of gone away from investing, present company excluded, of course, into our future. And we respond to the demands of the market. We're a long-term business responding on a short-term basis. Everyone wants cash dividends. People forget about the importance of profitable businesses in emerging markets that pay taxes as well. There are other stakeholders. So this is a very interesting time. And, this crash correction you refer to is a good reminder that, the mining industry in general has to keep a good focus on the horizon. And really our ability to react to these short-term things is dependent on our previous activities 2-3 years ago.
Well, true. Mark, what also winds up happening in times like this, though, is that countries where one operates tend to want more piece of the pie, whether that's in taxes or with what happened with Kyrgyzstan and Canada's Centerra Gold, where it basically becomes nationalized overnight. You've worked in Africa for quite a long time as well, and I wonder, are governments wanting a bigger piece of your pie? You've been dealing with this for a long time. How do you manage it? And is this different?
So no, it's not. It's cyclical. I think that when you take over a mine, that's not sharing the pie. That's just taking the whole pie. So that's a little different. But certainly, the emerging markets, the developing world, are financially extremely stressed. And again, it's often the point I make to fund managers. We've got to balance the ability to return cash value to our fund managers and the funds that invest in us. Equally, we've got to be supportive of our host countries who are, often, certainly now, under a lot of pressure. And you would have seen Barrick has advanced taxes in multiple jurisdictions, including Nevada, the United States. So, it's not exclusive to the emerging or developing world. And it's about how you keep your social license and partnering with all your stakeholders. That's the new game in town, is you can't just be exclusively there for investors. You have to be there for the other stakeholders.
Mark, how are you managing your assets from a COVID point of view right now? We're seeing Delta resurgence in various parts of the world. Where vaccines are available, are you going to mandate them? What are you doing on masking? Can you give us an idea of what you're doing from an operational point of view?
We've got very strict mandates. We are growing our vaccination rates. In the Dominican Republic, for example, we're now at 96 first vaccine, 86 second vaccine, and about 8% on the third vaccine. Similar statistics in Argentina. Chile's just about all done. We are now building our vaccination profiles in America. Canada is pretty much under control. The big challenge is the United States. The politicians lifted the mask mandate prematurely. We're dealing with lots of different forces, and really it's all about discipline. And so in Nevada, we back to full protocols, which kept us working right throughout the pandemic. And we're about 25% vaccinated in Nevada. It's the one that really needs more focus. And America in general, as I'm sure you just have to watch your program and you see the challenges that America is facing. It's got all the vaccines, it's got the infrastructure, it should get there.
Mark, a question on that. In terms of workers, are you having to hire more people right now? And what kind of wage pressure on that end are you seeing?
We haven't had that. We have seen some turnover in Nevada. The U.S. is the one where the work demand is the highest. But again, some of that is because we've been changing the culture of that business. We've got a lot more younger people, a lot more women coming into, and by design. So at this stage, we're not seeing that. But again, there is competition definitely visible. New bulls in the U.S. and also the junior market is really alive and well and promotional, and it does attract certain categories of workers.
Mark, it's always wonderful to get your perspective. We really appreciate your candor as always. Mark Bristow, Barrick President and CEO. All right, coming up, Warren Buffett's Berkshire Hathaway is reaping up benefits of the U.S. economic recovery. We'll break down those earnings coming up next. This is Bloomberg. Well, Berkshire Hathaway rode a strong comeback in the post-COVID economy, racking up its largest second quarter profit led by railroad and manufacturing businesses. Bloomberg's Dave Wilson has a deeper dive there. Hey, Dave.
Hey, Alex. Yeah, I mean, it was quite the quarter for Warren Buffett's conglomerate. You look at that bottom line figure, $28.1 billion, definitely jumps out in terms of being the most for any company in the S&P 500. Now, about 3/4 of that was investment gains, and Berkshire will tell you that, in any given quarter, that number is, quote, usually meaningless, as they say in their press release for earnings. That said, if you looked at their operating income, it was up 21%. And it wasn't the insurance businesses, Geico and all the rest, that delivered the growth. It was all about the rest of the company, utilities, energy, railroads, manufacturing services and retail, which they all lumped together. I mean, their operating income more than doubled in the quarter. So, it's clear that Berkshire benefited from the U.S. economic recovery. And you could argue to some extent that's reflected in how well Berkshire shares have done this year. During the first half, up about 20%, whether you look at the A shares or the cheaper B shares. And that's the best performance over that first 6 months of the year since 2013. And what that's meant is that Berkshire has backed off a bit when it comes to buying back its stocks, something that it has done increasingly in the past few years. Spent about $6 billion in the second quarter, down from $6.6 billion in the first, and way down from levels that we saw in the second half of last year.
Dave, great stuff. It is a fascinating story, and watching what the component parts are all doing. Dave Wilson, thank you very much indeed. What do we got coming up for you? We're going to talk to Gordon Johnson, GLJ Research founder and CEO. We know his thoughts on Tesla. I'm actually genuinely curious to get his take on what's happening in the rest of the market. He's not a fan, but where else do you think we should be putting money to work? Anyway, Gordon is going to be joining us next. We'll find out. Should be nice. This is Bloomberg. Nearly 1:30. We're live from London. I'm Guy Johnson in London. Alix Steel, of course, is over in New York. And this is Bloomberg Markets. Alex, let's talk about where we are with these markets right now. RBC's Lori Calvasina, she's boosting her view on tech. She's going from market weight to overweight. However, there's a little few caveats around all of this. She acknowledges that the growth versus value trade may be a little bit choppy until the end of next year. Anyway, let's dig in to what Lori's saying, get a bit more detail, figure out what's going on here. Bloomberg's Abigail Doolittle is looking into how this trade has been playing out on the tape.
Well, it's very interesting call for sure by RBC Guy on growth versus value. So let's take a look at these two styles on the year, because you will see in orange, growth outperforming value slightly, but not by a huge degree, up about 20% on the year, value up about 16%. And you can see that they're mainly trading close together. But that upgrade of tech is so interesting. If we take a look at some of the top sectors on the year, energy and financials, those are the top sectors on the year, both up about 28% year to date. So RBC is sticking with both of those sectors. However, materials, they are cutting in terms of weighting. And then, as you mentioned, boosting technology, which right now is up about 19%. Now, this is very interesting because it may suggest RBC's view or say something about RBC's view on rates. If we go into the Bloomberg terminal and take a look at a great long-term chart, what we're looking at here in white is the 10-year yield, in yellow, the 10-year yield, and in white, it is growth versus value. So you can see that value has really been underperforming. That suggests that maybe RBC, Alex, thinks that yields will be lower for longer. helping out tech.
All right, Abigail, thanks so much. Really appreciate that. Let's get more with Gordon Johnson, a GLJ research founder and a CEO, joins us now. Hey, Gordon, how you doing? It's good to chat with you. Give us your take on the overall markets. If we see this choppy value versus growth rotation, how are you playing that in the next, say, 3 months and then 6 to 18 months?
Yeah, thanks for having me. So I think it's a very important dynamic that has developed over the past week. And more specifically, we know that Fed President Kaplan and Fed President Bullard were QE hawks, right? They said that they want to start tapering. But we got additional comments last week from Waller and Clarita, who joined the chorus of guys looking to start to taper. So we think that's going to be negative for rates. And when you also include that Senator Manchin last week came out and said we need to start tapering immediately, giving the Fed some cover to start to do that, as well as his comments today saying that he's not going to support extending unemployment and further moratoriums, we think that rates are going to start to rise. And one last thing, keep in mind, the Treasury had to work down the TGA account, the Treasury General Account, essentially their bank balance sheet, from about $1.8 trillion to $500 billion. That's liquidity that went into the market over roughly the past 3 months. That's done. And as the debt ceiling gets worked out, you're going to get new Treasury issuance. So we think the reason rates have come down is largely due to a supply shock of Treasury issuance, and we think that's going to resume very soon.
Are we going to get volatility, though, Gordon? We've known this is coming. Can the Fed taper without a tantrum?
That's a great question. I don't think so. I think that if there is a taper, there's going to definitely be a tantrum. But I think that, given that you now have people in Congress pushing for a taper, I think that gives them cover. And I think the CPI print this week is going to surprise the upside. And again, I want to stress this point. The Treasury had to stop issuing effectively debt to work down their TGA account. That was a supply shock of Treasuries, which sent yields lower. That dynamic is going to reverse when the debt ceiling gets worked out in October. And I think that's a dynamic that people haven't looked at that we think is going to resume the fears of inflation as rates start to go back up. So we think that's going to be a key point to look at over the next few weeks.
So where do you go for safety with that?
Yeah, so we have a buy rating on U.S. Steel. We have a buy rating on Cleveland Cliffs. We have a buy rating on Cameco, which is a uranium play. We think the inflation trade is alive and well. We think the temporary blip in interest rates is indeed temporary. So we think as those inflation fears reemerge, we actually think tech is going to underperform. So given your comments before we came on, we think that's going to be the inverse of what you want to do. We think rates are going to go up, inflation fears are going to resume, and some of these material stocks are going to continue to outperform this year.
How are you factoring in Delta into your thinking, Gordon?
I'm sorry, I didn't hear that. What was that?
How are you factoring the virus and the resurgence of the Delta variant into your thinking around these markets?
Yeah, that's another great question. But I think if you look at the data, hospitalizations are going up. In countries where you've had significant vaccines, the actual amount of severe illness/death has collapsed significantly. So while no doubt politicians will try to use that as a measure to push policy, we don't think it's going to be as big a risk as the prior variants were. So I think that's going to be a headline risk. We don't think it's going to be an actual fundamental risk. So we still think inflation fears resume here in the next month or two.
So along that point, when we just are almost out of the earnings season, which were really great numbers, sure, a lot of them were easy comps, but still really good. Do you feel like that's stealing growth from 2022? Or do you feel like we can maintain some kind of growth momentum even if we have higher prices?
Yeah, no, I think overall you're going to have the inflation, and I think that's actually going to weigh significantly on growth. If you look at some of the data points coming out of the U.S. and China, right, you look at the construction numbers that came out last week, the automotive numbers that came out last week, they were both weak, right? You look at what's happening in China, their GDP numbers are being revised down. Inflation is a nasty beast. So as inflation, continues to reign heavy on the global economy, we think actual growth rates are going to come down. And with respect to earnings, as you guys know, the sell side has a tendency of lowering numbers to make the bar very easy to jump over. So we think the dynamic of beating, adjusted earnings is going to become less important. I think some of these macro data points, which have been worsening, not getting better, are going to come to the forefront.
Great to talk. Gordon, thanks very much indeed. Really appreciate it. Gordon Johnson, GLJ Research. Thank you very much indeed. We're going to carry on the conversation. Massive payroll number Friday. The JOLTS number just now really strong. CPI coming up. We're going to have more on inflation. We're going to have more on growth concerns. We're going to be talking to this man, the former New York Fed President Bill Dudley. He says U.S. Treasury yields can't stay this low forever. He joins us next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Barbara Humpton, Siemens USA Holdings CEO. That's at 1:30 p.m. in New York, 6:30 p.m. in London. This is Bloomberg.
So we're going to get a lot of Fed speak this week. We're kicking it off right now. Atlanta Fed President Raphael Bostic speaking on building an inclusive economy. We're going to bring you any headlines that he makes. We're going to continue to bring you the headlines that we get throughout the week. Obviously, a lot of data as well. We've just had JOLTS. We're going to get CPI. There is a lot going on. This debate around when to taper is increasingly ferocious. Let's get another take on this. Former New York Fed President Bill Dudley weighing in on the rate debate. In a Bloomberg opinion column, he wrote this: quantitative easing has sustained the bull market in bonds beyond what is consistent with longer-term fundamentals. This suggests that investors would be wise to take advantage of the recent rally and take some money off the table before the Fed's largesse ends. Bill Dudley joins us now. Bill, great to have you on the program. When does that largesse finally run out? We had an amazingly strong payroll number Friday. Amazingly strong, maybe slightly overdoing it. It was strong. We've just had a 10 million print on JOLTS. We get a CPI number coming out later on this week. How close are we? When does the Fed run out of excuses and finally pulls the trigger on this taper?
Well, they're obviously getting closer because they've altered their language in the Federal Open Market Committee statement to talk about the fact that they no longer need to see substantial further tightening from here. They've already made quite a bit of progress. So I think we're a couple months away from when we'll actually see an announcement from the Fed. And then maybe a month or two after that, the taper will actually start. Taper will probably take, 8-10 months to complete. And then after that, people will start to worry about when will the Fed actually raise short-term rates.
Does that result in a tantrum, Bill?
Well, I think that the risk of a tantrum this time is less because people understand the game plan. First, we taper, then we raise short-term rates, and then we start to let the balance sheet of the Fed shrink. We didn't have a game that was all laid out like this last time. And so I think people are more comfortable. And also the Fed's a lot more sensitive to making sure that there isn't going to be a taper tantrum. They've been very, very careful in terms of how they communicate.
What is your assessment of what is happening in the labor market right now? Some real strength starting to show up, yet there are still plenty of people on the margins of the labor market. As I say, top of the hour, we had a JOLTS number, well above expectations, coming through at 10 million. The previous number revised higher as well. There are a lot of job openings out there. The supply side of the economy isn't kind of picking up and responding fast enough. But do you get a sense that that process is now accelerating, that we are going to see the labor market healing more quickly as we start to get towards the fall?
Well, the key question is, as you said, what happens to labor supply? We still have an unemployment rate that's pretty high relative to where we were in February 2020 before the pandemic began. Yet we have a huge amount of job openings, and businesses report they are having trouble finding labor. So that's really the conundrum. On one hand, the labor supply seems tight. On the other hand, when you judge by the number of jobs we're short from where we were in February 2020, or the unemployment rate still seems like there's quite a bit of slack in the U.S. labor market. I think we're going to know a little bit more when we get into September, October, when schools reopen, when unemployment compensation benefits, the supplemental benefits expire. So I think we'll know a lot more a month or two from now.
So to that point, I mean, the big question I think is, are people wanting to do things like stay at home more, and that's affecting what kind of jobs they're looking for. It's affecting how they're positioning themselves with their employer for a wage increase. Like, don't worry about my wage increase, let me stay at home for 4 days. And that's a different kind of recovery than anyone that we've ever seen. So does this kind of stay at home recovery factor into how you view stuff? Like, what's your assessment of that?
Well, there is a risk that the labor market is actually tighter than what we think it is on a long-term basis. In other words, the shortfall of where we are relative to February 2020 may not be that relevant if people are actually changing their behavior. So I think we don't know the answer to that yet. And I think the Fed doesn't know the answer to that yet. And we're just going to have to wait for more information. But it's possible that we get to full employment quicker. And in that case, the Fed might have to do the taper on a faster pace, so that they can actually raise short-term interest rates in a more timely way. It's very unlikely that they're going to be tapering the asset purchases and raising short-term rates at the same time, because that would be adding stimulus by buying assets and taking stimulus away by raising short-term rates. So the taper process has to be complete before the Federal Reserve can actually raise short-term rates, in my view.
Incredibly negative real yields right now. We're getting a CPI print later on this week. You have seen a pickup in yields over the last few days as a result of the data. But nevertheless, how quickly do you think things could change over the next few months as we go through the kind of process that you're alluding to? How gradual do you think this taper is going to be? How quickly could it happen on the other hand? I just want to get your sense of, you talk about maybe investors needing to take an opportunity here. How quickly do you think things are going to shift?
That's very difficult to say. I mean, one obvious question that we still have open is, how is the Delta variant going to affect people's behavior as we go into the fall? The last payroll employment report was essentially backward looking before the Delta variant really led to this sharp acceleration in cases that we've seen over the last few weeks. So is that going to affect people's behavior? Is that going to affect employment and the strength of the economy? So I think there's a lot of uncertainty about how this is all going to play out. The Fed is going to try to be very, very careful, though, to avoid the kind of taper tantrum that we had back in the prior business cycle.
Hey, Bill, last question real quick. Who do you think is going to be head of the Fed in 12 months?
I don't know. But I certainly think that Jay Powell is doing a fine job. There's certainly plenty of precedents for reappointing a Fed chair that's doing a good job. So that seems to be the most likely outcome.
All right, Bill, thanks a lot. We truly appreciate your time today. Thank you, Bill Dudley, former New York Fed president and Bloomberg opinion columnist. Thanks very much. All right, coming up, a golden deal. DraftKings is buying online gaming company Golden Nugget in a deal worth about $1.5 billion. Tillman Fertitta, owner of Fertitta Entertainment and Golden Nugget Casinos, joins us next. This is Bloomberg. Well, Golden Nugget online gaming is surging after agreeing to be acquired by DraftKings in an all-stock transaction valued at about $1.5 billion. Well, joining us now with more on the acquisition is Tillman Fertitta, sole owner of Fertitta Entertainment, the restaurant giant Laundries, and the Golden Nugget Casinos and Hotel, and NBA's Houston Rockets. Tillman, we could talk to you for a long time. Lots going on here. Thank you so much for joining us. First, tell us about the deal now. Online betting is growing so fast, so why make this deal right now?
Well, I mean, let's be honest. We use this term best in class, and DraftKings is definitely best in class. They're a tech company. We're a bricks and sticks company. And this is a great opportunity for them to come into Fertitta Entertainment and pick up all of our databases from the Houston Rockets, from Landry's, from the Golden Nuggets 24 Karat, from Select Club. And it's good for us, too, because we're going to take their customers and they're going to be able to use their points and be part of our ecosystem. But for us, they're the leader. They're the best at this. They have a strong balance sheet. Yep. There's going to be a few survivors in this. And there's a reason their name's DraftKings. They're going to be the king of sports and iGaming. They're the best at sports betting. We have a great platform of iGaming, so combining the two is going to make it really special. And there's a reason I wanted it to be an all-stock deal.
Tillman, in some ways you've come across to this deal the long way around, i.e. via a SPAC. Were there any talks before the SPAC deal was done. Why is it kind of happening the way that it's happened?
Well, you got to remember, a lot has happened in the last 18 months. I mean, Golden Nugget Online Gaming was a little piece of my huge company doing $25 million in EBITDA. And it was spun out during the pandemic. And, here we are today selling it, for a huge amount of money because we've all realized the value of online gaming and sports betting online, which continues to get approved in new states, continuously. This is going to be a huge part of the American economy, is online sports betting and gaming in the years to come. And there's going to be a lot of consolidation in it. There's going to be a lot of players in it, just like every industry that ever happened in the beginning. And we felt like DraftKings is the best from a technology standpoint, a management standpoint. Jason has an unbelievable team that he's put together. And this isn't what we do. And I felt like, why shouldn't I ride their horse and take their stock at the same time? But we can help them by building more Golden Nugget casinos around the country.
But why not do this a little while ago? Why go via the SPAC? When did the conversation start? I'm just kind of curious as to how the whole process happened. You obviously saw the value in this asset, and you clearly like what is happening with DraftKings. Why not go direct?
Because we did not. This all happened so quick. Everybody forgets that this was not a huge industry. Everybody has to remember where even DraftKings was a year and a half ago and 2 years ago as a company, and where we were as a company a year and a half and 2 years ago. We never had talks. We didn't know where this industry was going. None of us, not DraftKings, not us. This is all something new in this new America.
So, Tillman, talk about something new. COVID and then now the Delta variant. If we'd had this conversation a few months ago, it would have been a little bit different. But now, how are you dealing with the Delta variant within all your businesses in terms of vaccination requirements, mask mandates, return to office, return to work? Can you walk us through your thinking? What are you noticing? What are you seeing? How do you feel about stuff?
Well, I mean, this is unbelievable. And remember, we're only on D, the Delta. There's a lot of letters in the alphabet. So today, our office is operating. All of our industry is operating in the casinos. Employees are wearing masks. Louisiana and Nevada are making customers wear masks. We're having our employees wear masks everywhere. And hopefully what happens here is what happened in India and Great Britain, is the fact that it has a quick pop coming out of the 4th of July, and then it dies. But this is something we're going to deal with. It is not having a huge effect on business whatsoever. But the one business that will thrive if this does happen is the online gaming and online sports betting. So it helped us when this was the only business we had that was open at one point. And so it was a huge positive for us. But hopefully this is a little bump in the road, and we'll all get through it.
Yeah, agreed. I think we're all on board with that. I did want to ask, though, about any sort of pushback in terms of people coming into casinos and asking them to be vaccinated. Like here in New York, for example, restaurants, you have to have a vaccination passport to eat indoors. What are you noticing in terms of that?
So far, only New York has done it. I don't agree with it. I'm going to make my little hostess the vaccine police. I wish everybody would get vaccinated so we wouldn't have to deal with this. I wish there was a way that we could plead with all these Americans that have it. I personally can't understand why somebody will not get vaccinated. And, that's one of our things in our company is push our employees and push our customers to get vaccinated.
Tillman, in 20 seconds, any shortage of labor right now?
Continues to be a shortage of labor, which is almost unbelievable with unemployment still where it is. But that's what happens when you throw money after money after money in the economy, and we continue to do it. with one stimulus package after the other. But I'm not going to complain because a lot of that money is coming to my casinos and restaurants and my online gaming. So if the government wants to keep putting money in everybody's pockets, we'll be glad to take our little piece of the pie.
Tillman, I'm sure it's not little. Great to speak with you today. Thank you very much indeed for your time. A really important deal, a really important transaction, as you say, in the evolution of the gaming business. Tillman Fertitta, owner of Golden Nugget Casinos and Hotels. Thank you very much. It's interesting, Alex, what everybody's saying about getting vaccinated. I come back to that conversation we had just a moment ago with Barrett.
Yep, exactly.
Okay, coming up, European close. This is Bloomberg.